Hi, this is Thinking Solo. I'm Ryan DeRusso, a Feeling Financial Planner, and today I want to talk a little bit about the worst day of the year for the self-employed or small business owners. It's tax day. Now, I know you're thinking, everyone hates tax day. No one wants to sit there and pay taxes to Uncle Sam. But for the self-employed, the small business owner, it's a double whammy because you're dealing with last year's taxes and you're also having to pay current year taxes. So it's a double hit from the IRS. So today I want to talk about a few ways to manage that huge expense. But before we get started, make sure to click that subscribe button. Okay, now let's talk about everyone's favorite topic, taxes. Just kidding. We're not going to talk much about the X's and O's of paying taxes. Instead, we're going to talk about how to pay fewer taxes. The reason that this day is so expensive for the small business owner, the self-employed person, especially if they had a good year, is because they're making up a difference from what they estimated from the previous year, and they're having to pay a higher amount of estimated taxes for the next year. So what does this mean? So let's say in 2021 you made $80,000. In 2022 you're paying estimated taxes on that $80,000. But let's say in 2022 you had a great year, your revenues went up $20,000 and now you made $100,000. Well, come tax day, you have to pay what you owe for that extra $20,000 you made, plus you have to pay estimated taxes based on that higher amount, the $100,000. So that is a double whammy right there and a huge headache. On top of that, if you don't manage it correctly, you're paying fees on top of it, like penalties and whatnot to the IRS. And let's face it, no one wants to pay penalties. So here's how to handle that. Here's how to handle that situation throughout the year. So how do you handle this situation? Well, the first thing to say is you tackle it head on. When I first started out as a self-employed writer many years ago, I knew I had to pay taxes, but I really avoided it because I wasn't making that much at the time. And so it was the last thing I wanted to worry about. Well, this resulted in a pretty large tax bill at the end of the year, considering my net worth at the time. It almost forced me back into a regular day job. And let's face it, none of us want that. So that experience really helped me understand the value of planning for taxes, even if it's not the most fun thing. It will protect you throughout the year. So here's how to handle it. And to really get a gauge of how to handle it, you need to see a few different numbers. But let's take the numbers easily with this fun little graphic that should come up right about now. All right, that was a fun little graphic, and you saw a few different numbers. That first number, the 33% number, that's a rule that many new self-employed or small business owners use. It's a way to kind of estimate taxes throughout the year without really taking a head-on approach to figuring out like how much you owe and whatnot. But it's a very simple process. So what you do is when you receive a check from one of your clients, you immediately take 33% out of the check and put it into either a different checking account, a different savings account, or even just a different bucket within your own checking account or business account. What that 33% does is it covers the federal income tax, the self-employment tax, and state taxes. So let's go through those three. So the reason 33% works is because often when you are starting out as a solo business owner, you're not making more than $190,000 if you're married filing jointly, or $95,000 if you're single. So that's the 24% level for the tax bracket, and so you're normally not making that over that. If you are, you need to manage that. You need to go up a little higher, but that's something to consider. The other thing you have to worry about is the self-employment tax. And so the self-employment tax is basically what covers your Social Security and Medicare. When you're employed, you pay half of this amount, and your employer pays the other half. But since you're self-employed, you have to pay the whole thing. And that extra amount is called the self-employment tax. And so you have to manage that, and that's about 7.5%. And then you also have to consider state taxes if you are in a state that deals with income tax. So that's where the 33% rule comes in. It's not a perfect design, but it can help make sure you have enough in your account when estimated taxes come and when that final tax bill comes. Now to tackle those other fun numbers, the 90, 100, 110 rule. So the IRS has set out limits for estimated taxes. They're basically saying that you either need to pay the lesser of 90% of the taxes you owe this year in estimated taxes, 100% of the taxes you owed last year, or 110% if you make over $150,000 this year. So you need to pay 110% of the taxes you paid last year. And you have to pay the lesser of that amount, of those two amounts, the 90% or the 100 and 110%. This gives you flexibility and options as you're making money throughout the year, because you can determine how you're going to pay estimated taxes based on how good of a year you're having. So let's kind of tackle an example. So let's say in 2023, after making $100,000 in 2022, you now make $120,000. You need to pay either 100% of the taxes you owed in 2022 or 90% of the taxes you owe in 2023. Again, it's the lesser amount. So what do? You can use the extra funds that you've made in the year and either use that extra money to reduce your taxes, say, pay into a retirement account or some other tactic. And so you can actually use the 100% of 2022 as your target, using the extra funds to try and reduce your taxes, even though you're making more money. But then again, say your money drops, and say in 2023 you make $80,000. Well, now you can consider paying 90% of the taxes you owe in 2023. As opposed to 100% of the taxes you owe in 2022. Again, you can use the extra funds to then fund a retirement account or another tool to reduce those taxes. And this is something that you can manage throughout the year. So maybe at first the year is slow, and so, okay, I'm going to pay a little less in taxes. I'm going to target that 90%. But then suddenly the second half of the year, it starts to climb. Well, now you can say, okay, this is going to be a better year, so let's make an estimated tax that's a little bit more, later on in the year. And by doing this, you're getting closer to that actual number that you need to get, and it kind of gives you an idea of what you're going to need to pay by the end of the year. And so then tax day doesn't become this overbearing sort of thing that you're not really sure about, but you hope is small, when in fact you're just managing it throughout the year to make sure it stays small. Let me know how you handle things in the comments below. There's all sorts of ways to handle the estimated taxes, and there's no one or two ways. So let me know how you handle it. But this has been Thinking Solo. Make sure to like the video and subscribe, and I'll talk to you soon.